I think that even though we have moderated our 2021 GDP growth, now we are closer to 6% than the 6.5% that we thought earlier this year. We still see the consumer being very willing to spend. The forecast for them is 8% versus 6% for the overall economy. And so as a result, we think that because consumers have been, in a sense, locked up for a year and a half, they are very willing to go out and spend. Yes, they might end up being comparative shoppers, but still, we think that they will end up spending in the end. Low interest rates are also likely to help. On the one hand, with the 10-year note now trading below 1.2%, some investors are worried that that is an indication that the economy is likely to be slowing in the next couple of quarters, whether it's from the Delta virus, whether it's because we have the infrastructure spending package that's now in jeopardy because the progressive Democrats are saying that they will not sign it unless there is an extension to the eviction moratorium, as well as the approval of the other more socially oriented stimulus bill that is very expensive. So I think right now bond traders are worried that maybe the economy will end up slowing, and that is the reason that yields have been coming down, which is a double-edged sword, because lower yields are a concern of future growth. But at the same time, investors are thinking, well, it'll at least stop the Fed from raising interest rates anytime soon. This month, we have the Jackson Hole meeting, which is not an official Fed or FOMC meeting. That next one is in September, but it will provide guidance, if you will, for what the members will be discussing in September. We still think that they'll be discussing interest rates, they'll be discussing tapering, but they probably will not be sharing with us any changes to what is an anticipated timetable of tapering to start in the first quarter of 2022 and rate increases to start a year later. A lot of investors had been worried that maybe the Fed would start the tapering in the end of this year, but if we do end up seeing a slowing of economic growth as predicted by the drop in the 10-year yield, the tapering will probably be delayed until the first quarter of next year. Investors are investing because they do have an awful lot of money that they are not needing right now. They want it to put to work. They find that the equity market is the best place for quick gains, but we are looking at valuations that are 30% higher than the average PE ratio over the last 20 plus years. So by many calculations, valuations are expensive, but at the same time, they are offset by the very low interest rates. So I would be more worried about the change in the direction of interest rates with the 10-year yield going back toward 2% right now than I would worry about valuations, because this market has been accepting very high valuations for the last several years. The Fed, I think, is of the mindset that if they are as transparent as they've been trying to be, then maybe the market will not get spooked. One way to be transparent is to float trial balloons, have Fed presidents talk about tapering and have them talk about raising rates, have them talk about a speeding up of the tapering timetable, et cetera, in a sense to get the word out there that the topic is open for discussion. And so if investors hear that enough, then it's as if it's old news, and this old news will therefore not end up upending the stock market. I think that's a possibility that the Fed wants to have the data settle down before they make longer term changes that could help or adversely affect that data. When we look to inflation, we don't think that the peak quarter will be until the third quarter of 2021 at 5% for year-on-year change in headline CPI. But if you look a year later, our expectation is for 2.8%. So inflation is almost going to be cut in half in the subsequent 12-month period, because it does appear as if it's transitory. So the Fed doesn't want to react too quickly nor overreact to data that would likely be coming down.